Hey everyone, this is John Robinson from Blueprint. Today is Tuesday, May 31st, and this is the monthly asset allocation update video. It has been a wild year. It's been a wild month, and really the theme this year for us has been discipline, and there's a time to be on the offensive and there's a time to be on the defensive. And for much of this year, we've been on the defensive, and that's really what we're going to see heading into June. In the longer form written piece this month, which this video is made as a supplement to, we talk about preparation. And sometimes there's a cost to preparing for something that has not happened yet, but that you have very high odds or high probability potentially of having. And with that comes the cost of annoyance. And sometimes there's a hard cost in terms of money and certainly opportunity cost in terms of time if the thing doesn't happen. But we all know what the benefits are, and the benefits are that once this thing happened, whether it's a natural disaster or something else, looking back, you are far better off having prepared against something that can hurt you. Even for those costs, the benefit outweighs the cost. And so we write a lot about that in the monthly note and really tie it back to our mindset around protecting capital, protecting against the downside, particularly in this type of environment. So with that said, let's take a look at the allocations for June. First up, U.S. equities, there's no change. We have downtrends across all time frames there, as well as international stocks. Real estate is the only equity or quasi-equity-like sector that will see a reduction this month. We're already fully defensive in U.S. equities and emerging and foreign developed. Real estate was the last holdout, if you will, on that front, and we have downtrends now over both time frames there. So we'll get to our minimum allocations in real estate, which puts us at the asset allocation level fully defensive in terms of our positioning relative to equities. Treasuries, there's no change there. We still have downtrends across all time frames as well as TIPS. Despite the inflationary environment, the more financially related asset classes like inflation-protected securities, at least at the ETF level, have not been highly correlated to the rate of inflation and therefore remain in downtrends, and we are positioned accordingly. Alternatives, we express that through gold. Gold is now in an intermediate term downtrend, but the longer term trend remains. So we'll be reducing that position, but not at minimum levels. And where is most of this exposure going? Well, it's going to ultra short term fixed income. And this has been a repetitive theme for us, certainly this year, but for the last 12 to 18 months, as our duration has steadily declined. We are at minimum levels of duration and near maximum levels of short-term fixed income. So as we sell real estate, we've already sold U.S. equities and foreign equities and longer duration fixed income. This is all getting pushed to cash equivalents of a 60-30 and even in some cases a 6 days in duration allocation. So what this looks like is for this month is essentially we're reducing exposure to real estate as there's downtrends across both time frames now, and handing that off to treasuries of the ultra short-term fixed income variety. So what are the takeaways? Well, you probably already know this or certainly feel it. Equities remain in downtrends, and we are going to remain defensive heading into June. With the only change in allocations, material change being that we're reducing exposure to real estate and handing that exposure to ultra short-term fixed income. And lastly here, preparation. For us, we are all about the data. We are a systematic and rules-based manager because we want to remove emotion from the decision-making process. We often say this doesn't remove emotion for us, it doesn't remove emotion for you as our partner, but it does from the decision-making process, and that's really where it matters. So as we see trends now across time frames down in U.S. equities at a macro level, foreign, emerging, and real estate, this is not a time for us to be ignoring the data. The data says that we should be defensive to protect against further declines, as we have been on average this year, and certainly for the past 30 days or so. And we'll remain like that for the next 30 days. We also know that there's potentially associated with that is an opportunity cost. If we go defensive and the markets rebound, we will end up getting back long. The worst case scenario for us is only going to last typically 30 days, and then we'll reverse our position. But for now, we want to prepare. We want to prepare against larger drawdowns in equities. We want to help you prepare against losing your hard-earned money that you may need soon, whether you're retiring, whether you're saving for something else, whether this is, very long-term money that you might pass to the next generation. For us, the important thing is to protect our rate of compounding and keep it at or near its highest point. Sometimes that means playing offense of being aggressive. Sometimes that means being aggressive on the defensive, and that's where we are now. The data says that we should be there as we understand it and as we look at it going back hundreds of years, and so we're going to honor that with our discipline and be defensive to protect capital against further declines. So, what can we do for you? If you have any creative ideas for us that we can put into action on the marketing front or on the communication front, I would encourage you to reach out to us. You see the website there, you see my email and phone number. You can reach out to me directly. We're having a lot of client calls with our advisor partners now, just answering questions and trying to keep people in their seats in this emotionally charged environment. So if that's you and you want us to get on a call and really partner with you on explaining what we're doing, explaining the world around us, and then how we're reacting or adapting to that, we'd love to help you. So with that, we hope you're enjoying the beginnings of summer as kids are getting out of school, graduations are happening. As we say in the South, cookouts are now happening a lot, our barbecues for our northern friends. And so we hope you're enjoying that. Enjoy the next 4 weeks, and we'll look forward to seeing you back here at the end of June with more updates. Thanks.